Like the more questions you ask a VC going into a meeting, the better you can orient your pitch in order to make sure, does this fit in their thesis or not? Because you as a founder can almost cut the deal yourself. You're like, look, it's not going to work where you guys sit. Founders should keep a benchmark of 3 months when they're raising, from first call to a term sheet. If anything happens before that, that's great, right? But what we saw in the class of 2021, 2022, it's very rarely repeated, right? It's only repeated in era of sort of zero interest rate cycles. I also appreciate it when founders don't really stick to a deck. I think presentation with just the slides is just, it's too structured. And I feel the best founders just know their product so well and their business that they go in and it just takes them 15 minutes to go through a rundown of the entire business and everything that's going on, right? So I think that for me instantly becomes a green flag.
Welcome, Varun. To set the scene for anyone else listening in, I host a founders community called the Founders Circle. We essentially have an online channel with lots of resources, but we also run meetups every 6 to 8 weeks. Now, I met Varun as he ran a Q&A session at the end of one of my meetups, and the feedback was genuinely so positive. I think particularly around the kind of demystifying of how VCs actually work and how you make decisions. The feedback I generally get from founders when speaking to them is that when they're speaking to investors, it's often with the intention of raising funds, but they don't normally have the opportunity to ask more general questions around how VCs actually make decisions, the inner workings of a VC, and I think that's really important for them to understand. So Varun, before we dive in, could you give a quick introduction to yourself and for Speedinvest for those who don't know you already?
Absolutely, and thanks a lot for having me here, Reese. So my name is Varun Rekhi, and I'm a growth investor at Speedinvest, focusing on the broader EMEA landscape, which is Europe, Middle East, and Africa. I specifically focus on growth stage tickets, which is investments ranging all the way from 2 million up to 15 million. So we typically try to come in at Series B plus, but that is sort of what I do in a 3-person team. What Speedinvest is known as and what Speedinvest is accoladed as is that we're a large seed fund with 1.2 billion in AUM. We've been in business for over 10 plus years, with the 4th generation of our fund now sort of backing founders across Europe. We come in at seed, we typically tend to lead rounds, and we invest across sectors. So I think that's pretty important to understand. Speedinvest is cut into 6 sector categories. So that is fintech, SaaS, climate industrial, deep tech, health, and then consumer. So that's us as a fund. We originally started with our roots in Vienna, but today we are in Vienna, London, Paris, Munich, Berlin, and Abu Dhabi. So long story short, I sit on sort of the growth side of a seed fund, and I quite enjoy what I do.
Awesome. No, it's really good to get that context. And I think with VCs in particular, there's a lot that goes on behind the scenes of a VC that founders just might not see, aren't aware of, from like how decisions are made, and also how partners are incentivized as well. I guess with that in mind, if you could walk us through, I guess, the internal mechanics of what a VC firm looks like. I guess starting with, what does deal flow look like? How do startups typically get on your radar in the first instance?
Right. So sort of to demystify the structure of a VC fund, I think it's very important to look at the end and the output in order to understand the input, right? So the output is you raise this vehicle to return money to people who are putting money into you, aka the limited partners, right? So for a fund that's, let's say, fairly large, right? If that's 200, 300 million, you need to return at least 3x of that, right? So then you sort of back that into your fund model and the number of deals you need to do, right? Every firm, every investment firm, every partnership has an idea of the number of deals that they want to do at seed stage, right? If it's a seed firm, so on and so forth for growth and late stage and buyouts. So for us, we have a set number of companies that we want to invest in across the different sectors, right? And each sector has an allocation, right? The 6 sectors that I mentioned, they all get an allocation. Within this, the way the mechanics are structured is, naturally, we see a lot of volume. We have a footprint across Europe where we tend to see at least 80% of the rounds that happen in Europe. We've either seen it in some capacity, looked at the deal, passed on it, accepted it, or so on and so forth. And there's a funnel, right? The funnel is so broad that you would see almost thousands of deals at the top and sort of coming all the way down to one at IC, right? The way that happens, it's obviously it's a patchwork of systems, right? Which up until the AI era was different software providers, right? It's how you create those integrations with the decks that come in, the way you set up the calls, the way you move processes forward, which we can get into in more detail. But primarily, it's what you would imagine is a typical enterprise company's sales CRM, right? You have inbounds. The inbounds are progressed to sort of, or outbounds, right? They're progressed to a sort of long list. Then you come down into a short list, right? And then you ultimately come down to pre-IC, IC, term sheet, and whether you win or lose, right? So that's the typical funnel. But the number of companies that exists in each stage of that funnel, they start really big and then they come down into like almost one deal, right? So that's how we're broadly set up. Each of the sector teams are independent in their decision making, right? So it really helps autonomy, it helps sector expertise, and it helps with speed of decision making, as goes with our name, right? So that's broadly us, right? And we could jump into a bit more specifics, but that's the structure.
Awesome. I think one thing that's really interesting you mentioned, because I don't think all founders are aware of this, but in terms of the responsibility to return a fund, I think most or some founders certainly aren't aware that as a VC you're raising yourself to kind of get your own capital.
Yeah.
What does that look like in terms of your responsibility for someone else's capital in that?
Yeah, I think I always say this, right? The number one responsibility we start with is that we have a fiduciary responsibility to limited partners who invest in us, right? And let's say if someone provides us with 100 million, over the next 10 years, right, which is the typical life of a venture fund, you are not promising them, but you're telling them that your aim will be to return 300 million back to them. Just very, very rough back of the book math, right? Now, to make that work, the venture power law comes into place, right? Where you invest in a certain number of assets, the multiple on your invested capital on one of those assets shoots past so much, 30, 40, 50, 100x, that you end up returning that capital as promised to those LPs. And obviously you keep timing in mind, which determines what an IRR is, but that's all math, right? The main component of this is we raise 100 from someone, we need to give them 300 back at a bare minimum, right? That influences the way the entire organization is set up, the way teams are structured, the sort of deals you want to look at, the ownership you want. The more quickly a founder can understand a venture fund's size, scale, and fund, like the more questions you ask a VC going into a meeting, the better you can orient your pitch in order to make sure, does this fit in their thesis or not? Because you as a founder can almost cut the deal yourself. You're like, look, it's not going to work where you guys sit. This is not going to work. And some of the best founders do that.
Awesome. And in terms, because I know you mentioned like enterprise level sales cycles, what does that look like in terms of when you're expecting or need a return? Is it X years? What's the...
So, you want to bench it with expected rate of return in public equities, right? So it goes down into that, right? And it goes a bit into finance, which is think about where that capital could be put to use, right? If you're asking an investor to, aka limited partner, to invest in an alternative sort of asset class, and you're telling that investor, look, I'm going to give you 6% back every year. The investor can simply turn around and say, why? Why would I do that for such a high risk asset? I would rather just go into the public equities or put it in the S&P and I get 14%, right? Which is the equity risk premium. So you always have to keep that as a benchmark. So whenever you model a fund sort of scenario, you need to give a premium on top of equity markets to be able to drive that fundraising process, right? And you need to see what amount of allocation in the LP's portfolio are you taking. There are very few LPs that will be 100% exposed to a particular asset class, right? And an asset class means private equity, venture capital, public equities, real estate, right? That decision-making influences the way we model the fund, the way we do deals. So a lot of times when we tell a founder, hey, listen, we can't invest in your round just because of dynamics, it's not founder dynamics always. Sometimes it's fund dynamics. Sometimes we cannot break out of our fund model because we're like, look, this math is just not going to work based on what we expect this to be. Because it's all an expectation, right? I think it's pretty important to note that nothing is set in stone in venture, right? It's all expectation, so.
Do you find that founders struggle to balance, I guess, realism with also making it enticing enough for you? Not being a $10 billion company, but also giving you enough return that it's worth Speedinvest investing?
Yeah, I think that's a good point, right? Because look, I see companies at the growth stage, right? So I can speak from the growth perspective, but I've spent time in seed before this as well. And I can say that there are a lot of times there are some very, very good companies that may top at, say, 10 million revenue, 20 million revenue. These are great businesses. They may not be suited entirely for venture capital per se, or they may not be suited entirely for our model of venture capital because we have a certain size and certain expectations. However, they would work really, really well for a micro GP, right? If a micro GP comes in with a small ticket, at a valuation of 5 million post money, and this company ends up, going to a 10 million revenue, 5x multiple, it's a 50 million business, that's a very good return for the micro GP, right? For us, it doesn't work. So there's always that question of, as founders make their short list of who to raise, and they are balancing that realism with, what we realistically think this is this big of a company, you can almost adjust your targeting list, right? But I would caveat with all of this, I'm not a founder, right? Yep. And I think the reason I'm not is because I don't have that sort of obsessive, positive delusion to be able to be a founder. Because you have to believe something that others don't believe, right? And that's what shoots past all these mathematical scenarios that VCs and analysts and everyone runs. Because all of this doesn't mean anything if the founder has belief and conviction, right? So.
Awesome. And on the note of the funnel, because you mentioned 1,000 companies can go down to one. What, from a time frame perspective, from first pitch to term sheet, what does that typically look like?
I hate saying this phrase, but it depends, right? So, and it depends across stages, from pre-seed to seed to growth. So pre-seed and seed, from first call to term sheet, there are some companies that would do it on a weekend, if there is hype. There are some companies that would take 3 months, right? I'm working on a particular round right now that will take us about 6 weeks, right, to get done. Everything is right. When you look at it and when you look at all the advice you give founders, everything is aligned with that company that I'm looking at right now. But the market is just not buying into that weekend close, right? And that weekend close is something that should not be the benchmark. I think founders should keep a benchmark of 3 months when they're raising, from first call to a term sheet. If anything happens before that, that's great, right? But what we saw in the class of 2021, 2022, it's very rarely repeated, right? It's only repeated in era of sort of zero interest rate cycles, right?
So, and I guess, how long have you seen it take? I'm thinking in terms of if a founder has X months runway, when should they be thinking about that next round?
Honestly, let's say today's June, right? If you feel your runway is lasting out till December, I think you should start being in the market. Right. So 6 to 9 months is a good proxy to start your conversations, right? And then obviously you wanna know your win points, right? Your win points are, depending on, let's say you're a seed company wanting to go for an A or a seed extension, what are your metrics? What's the story? What does the team look like? How much capital you need? How long will it take you to burn that, right? Just have that down to the T.
Okay, awesome. And in terms, we'll definitely come on to metrics later, but I think one thing would be good to understand as well, in terms of how the actual VC partners and the firms themselves are also incentivized. I'm thinking in terms of time frames, is there certain times in the quarter, how they incentivize in terms of deal flow? What does that generally look like?
Yeah, so that's pretty interesting, right? Because the larger the fund, the more deployment pressure there is. Now in the US, this point never comes up as a discussion, right? Because there are large funds, everyone has targets to deploy, there are enough deals. But when I look at EMEA generally, I say that, again, if you quickly do your diligence before going into a meeting, you will, as a founder, be able to quickly get a sense of, okay, this fund is this big, this was raised X years ago. I'm assuming that 40%, 30% is deployed already. So, you can sort of back out an average investment pace. If you're a really savvy founder, you can almost back out. You can almost then ask the tough questions to the VCs themselves, like, hey, you want to partner with us? How many deals a year do you do, right? Anytime a VC is asked questions that are specifically pertaining to their industry, the ones who are not experienced with it, they get a 404 error. It's like, wait, what the hell? Like, wait, what? It's like, just pause, right? And it's actually really fun, right? And I think founders should do more of that because you're really trying to understand the business model of the VCs at the end of the call. And because it's a 30-minute slot and you're using the last 5 minutes very strategically, I think it really is important for you to know that do you want to build a relationship with that person for 10 years? And it gives you a lot of insight into the type of fund
Yeah, completely. And I think that's one thing that I've noticed, particularly with the meetups. I think that's one thing that, as Aki said, I think sometimes don't feel comfortable. I think when you're in a pitching conversation, they don't feel comfortable asking around, well, why would you want to invest? Is my timing right? Do I come back in a month's time? Does things change then? And also think in terms of things like SEIS, EIS, it's important to know why would someone want to invest now, but not in a month's time or 3 months ago. Why does it change? And I think not many founders feel that they can ask that question during a pitch meeting.
I think you always should. I think we should re-emphasize that point that the founder-venture relationship is a two-way street of two individuals, right? It's super, super important that you realize that you get power from your VC, and your VC gets an extraordinary asset backed by a very strong team that allows the VC to build sort of a career-defining move with that. It goes both ways, right? The sad misconception is, and the more young a VC ecosystem is, and I've seen this in emerging markets, the more the perception is that it's a one-way street, right? So
Yeah, I guess in terms of when they should ask those questions, is it an initial meeting? Is that once there's a genuine interest there from the VC that's the right time to start asking about those sort of questions?
See, that's a tricky one because your first shot is 30 minutes. Let's assume it's a structured call, or let's say it's 7 minutes when it's like an in-person face-to-face at an event like a founder circle, and you're just having a conversation. It's like, boom, I just have to pitch. In scenarios like those, it's very tough to assess, right? You want to get a pulse of the person you're speaking with, right? At the same time, you want to come across as someone who understands the industry, and you should be like, hey, why do you guys want to invest in us? Or not even invest, what makes you interested in us, right? Or how do you look at deals? Or how many deals a year do you do? Do you write checks, right? You can ask all these pre-qualifying questions because that will help you assess your priority list when you make a list of VCs, if and when you decide to go down that fundraising route, right? So that's important.
Awesome, that's really good to know. I guess in terms of the kind of relationships between venture partners as well, because I think this is something that founders aren't aware of. Do you, I guess, have a network that you refer to? So if someone has a conversation with you, you find them exciting, but it's not right for Speedinvest. Would you intro to other VCs? How does the kind of dynamic across different partners work?
That's super important because you're balancing likability with capacity, right? And what happens is, if you really, really like a founder and you resonate with them, even if you're not doing the deal, the best VCs focus on what I call network capital, and they'll want to make sure that they can sort of circulate this deal to a friend in the industry. However, that's why I'm saying now likability and capacity, because one, it's a capacity thing, right? Like as a VC, you always have 10 things to do in a given day. So then you're taking out time from your day to make that introduction. You also want to be confident enough in that introduction that when the introduction goes to the other party from the VC, you're feeling good about it because it's your rep on the line as well. You don't want another VC saying, this person always introduces me to like bad deals, right? Yeah. So you're balancing all of that and you're trying to assess the strength of your relationships. Now, you don't think of all this, but if you really think of all this, this is what goes on, right? So whenever, you're like, okay, you know what, I want to introduce this to someone. If you can't do it because of fund restrictions or whatever the reason is, I think it really shows that you like the company. You're just not able to process forward. Right.
Awesome. That's really good to know. I think especially on that kind of 7-minute pitch and the kind of 30-minute call as well, I think in terms of what grabs an investor's attention, what makes you have that second call, and it's also important, I think, for founders to know what could kill a deal early. I guess in terms of the green flags, kind of what makes you excited and what makes you want to have that further conversation.
Yeah.
Are there any, I guess, key attributes, key things you look for that are green flags in a founding team, in a business?
Yeah, I think, for me personally, I think some of the best deals, and I think I'll speak from a growth investor lens. Yep. At the growth stage, it's more like the founders have been through a few iterations of fundraising, right? Pre-seed, seed, A, whatever, right? So they know the drill, right? So that's almost table stakes that when they walk into a call, they sort of just know the drill, right? It's like, hey, look, that's what I'm doing. I also appreciate it when founders don't really stick to a deck. I think presentation with just the slides is just, it's too structured. And I feel the best founders just know their product so well and their business that they go in and it just takes them 15 minutes to go through a rundown of the entire business and everything that's going on, right? So I think that for me instantly becomes a green flag. But that's my particular variable that I'm indexing on, right? That every VC will index on some of the other variable. I think I would be remiss if I said everyone has a set criteria. No, they do not, right? Everyone's an individual, everyone's human. They all view it differently. For me, I particularly view on, the ability to articulate and sell a vision in a concise manner, the ability to sort of have a conversation and understand and be empathetic, right? And the ability to sort of showcase your numbers in the macro context and where you want to go, right? I think that's super important at the growth stage for the first call, right? And then you naturally want to open up the data room and so on and so forth, right? But to go into a meeting, remember, you only have 30 minutes, right? On average, again, to understand someone else's vision of the world, right? And I think that's why it becomes pretty important. And I also say this in a lot of other places, that venture should not be anyone's first job, because you really need to have a bit of life experience to be able to go into that 30-minute conversation and understand someone else's worldview, even though they may not be from the same background as yours.
Yeah, awesome. And in terms of the green flags at different stages as well, because I appreciate when you get to Series A, Series B, you've got those metrics,
Yeah.
you've kind of got the figures. But and I appreciate your background's more growth, but I know you've been involved across lots of different stages.
Yeah.
Does that change from like pre-seed, seed, in terms of what you look for in a founder rather than the business?
Absolutely. I think pre-seed, seed, I did some of that before Speedinvest. I think at pre-seed, seed, it was really about the team's hustle, right? And these are all like soft sort of variables in that sense. These aren't hard variables, right? You want to see the ability, because you broadly cut it into 4 T's, right? Cut it into team, time, timing, and traction, right? And obviously the focus is on team, right? The biggest. You want to get a sense of backgrounds, their ability to pivot, their ability to hustle, and you want to just pick out more stories from them. So at the earlier stages, you actually want to spend more time with them in a casual setting to understand how they react, right? Because I think that's very important. Nothing is going to be set in stone in that pre-seed deck that will probably stay at Series C. Things will change, right? You want to understand how are they as a person, how do they react, how do they respond. At the earlier stages, pre-seed, fundraising, everyone responds the same way. Everyone switched on. Everyone wants to keep going. And then there's a natural, what I call it's not an effort decay, it's an optics decay. It's like you don't see the same responsiveness as you would see in pre-seed. It's only fine because priorities shift, right? That founder now has 60, 70 people to manage, right? So, but you look at all these points at the start. You look at how well they work together, right? You try to understand a bit of the founder's history if it's a co-founder duo. You comp all of this with the timing of this business, the traction in whatever ways they can show, whether they've done 150 customer reference calls to understand the pain points, or they've got actual revenue traction, right? And then you comp this with the TAM. And the last point on TAM is very, it's a metric for me that's just a data point, right? It should never be limiting, because the best companies will always expand the market. They'll open up a new market entirely, right? And we've seen this with countless examples. So when you put all of that together and you're like, okay, this is interesting, what's missing here, or what's compelling me to go forward, you really get that with those 4 T's, right? And you're in a very good position to assess it's a go or a no-go.
Okay, awesome. And on the kind of note of things like the TAM and the metrics, I guess, do you still look for any sort of traction when it comes to that pre-seed, early stage founder, or is it all about less about the product and the kind of traction and more about, do we think this founder can build something?
2 things. I think, again, depends on fund size and the macro environment you're in, right? I always say this, that true pre-seed should not index heavily on traction at all, right? And I know there are initiatives like Project Europe. I know, there are deals in our fund that we've done at true pre-seed. Other funds do it. It's not the same, and it's not as prominent as the US because of the depth of the capital pool in the US where true pre-seed happens. I did pre-seed with Octopus Ventures before this, and we weren't really indexing on traction, right? We were indexing on sort of all other elements. So in my opinion, true pre-seed should not. But then ask yourself, right? It's like when you list down all the variables on a blank spreadsheet, and you're like, okay, this is what I have, this is what I don't have. If you feel you're missing some of the key variables that, let's say, a serial founder already has, you need to up something else. So put simply, let's say you're a serial founder, you've exited a business before, you want to go out and raise just on a deck, you can, because you validated the theory of venture capital before. But if you've not done that before and you're down some points on that, tell yourself, I need to go up some points on some other aspect of the 4 T's. So you go up on traction. So it's almost like it's like a dance, right? It's like a dance of ice and fire. That where do you go up, where do you go down, and then when you come out to market and you're speaking with folks in the industry, what sells, right? And that's sort of what happens.
Yeah, brilliant. And in terms of things like financial modelling and like pre-seed to seed to
No.
Series A, that's what was my next question. Do you go down the point of doing financial models when you haven't got the traction, you maybe even haven't got the revenue at the moment? Do you factor in investment? Would you rather not see that on a pitch deck?
No, I would rather just see like a very detailed analysis of the problem that's been identified and the way you're thinking about pricing it. And I think that's it, right? Because then the pricing is important, right? It's like, okay, I have identified a problem and I think this is what I'm going to charge for it based on my understanding of willingness to pay or where this lands on the income statement or so on and so forth. I think that's it, right? Anything beyond that, just on the way here, I was reviewing a deck. Company's at 1.5 million today, right? And it says plans to reach 100 million ARR by 2026. So I'm just sitting there in the car. I'm like, okay, so you want to grow 90x in a year on a D2C product that I was looking at. Now, I'm not saying a D2C product cannot, but straight away showing me at 90x growth over a year when it's a seed plus round, I'm like, guys, come on, let's be realistic here, right? So
does that, out of interest, in terms of having those figures on there, because my next question I was going to ask was around red flags. Are they better off not having? Does that just give them more to defend when it comes to having those conversations?
I think it's important to have it in somewhere, because as a founder, when you're building through your business and your product, and you're speaking with customers, and you're understanding the 3 Ps of venture, which I'll explain more, you want to be able to understand, do I want to go into the venture cycle or not? And you need to be obsessive about that vision and that model inside your head. That I know why I'm going to a 100 million business, right? I know because this is what I'm seeing. These are my first few conversations, and I know, and I'm pretty confident I'm going to get to 100 million. I think it's important to have that, but don't use that as the key selling point, right? The key selling point is, these are my margins, this is the business, these are my customers, this is what I'm going to do with your money, I need to go. Right?
Awesome. That's really good to know. And on the note of red flags, are there any consistent red flags you see? Either that is, killed a deal in its tracks, and anywhere from pre-seed right to, I'd be interested as well to see how different those are at growth stage versus pre-seed seed.
So pre-seed seed, I think some initial red flags for me are the deck is too long, right? And these are all very surface level points, but I'll give surface level and then something more insightful. Deck is too long, too much analysis on financial modeling and so on and so forth. For sure, red flags. Messy cap table. There is a random advisor there with 20% of the cap table. Not ideal. Again, business has been around for too long and now raising their first institutional round. I'm not saying that's bad, but that has to have a reason why suddenly you want to get on the venture train, right? So that's on that. And then something on the inside is, your basic sort of selling red flags, right? Like if you just visualize this, if you're in sales and you're trying to sell, don't be late on a call, have your pitch ready, don't be late for a meeting. It's like just small things like that, even though I was late for our meeting today, right? So I should not be the one saying that. Some of those implicit ones, and I think at growth, it becomes a bit more different, right? It's like the red flags primarily stem a lot from the deal dynamics and the numbers again, right? You're either burning too much and you're not growing as efficiently. But then again, I don't call them red per se, because a red flag means it's a complete no-no. For me, these are all orange flags, because these are all flags that warrant a diligence further, right? Because what I've realized is sort of 2 years in growth, and then 2 years of doing multi-stage before that, and then doing IPOs before. It's like all these are just data points that you need to inspect further, because there's always a story. As an investor, it's up to you. Do you want to buy that story that they're selling or not? Very rarely will there be a true red flag that comes out in the initial sort of 60 minutes of interaction you have with a company. Very, very rare, right? I think it's only once that I've seen in emerging markets where, we had an advisor that was on every call. I look at the cap table, but the advisor is sitting on 15%. I was like, this is weird. And then I realized that in a lot of African deals, that's actually very common. So I went in with a preconceived notion and I came out learning something new about an ecosystem. So again, as an investor, you have to sort of be really flexible in your beliefs to know that a red flag is most likely an orange flag that warrants further inspection.
Okay, brilliant. And in terms of things like the red flags in people, I think more so the metrics, does that still become a factor at the growth stage? Have you not invested in a business because of the founding team at the growth stage, or is that much more pre-seed seed?
I would say that's much more pre-seed seed. At the growth stage, primarily rejecting on founders, I don't really think so. We've rejected on, the founder, like not rejected. We felt sometimes that a founder is not necessarily as charismatic, but that again doesn't matter. We've seen charismatic founders who, overpromise and underdeliver, right? And then you've seen founders who are sort of silent horses, who break quarter over quarter their own projections. So again, it's not one size fits all. It's more at the pre-seed seed, right, where you sort of see all of this, right? And even in the growth stage, a lot of times, a lot of the, let's say, under the hood comes out while you're doing post-term sheet diligence, in a way, where if you really run a background check, you're like, wow, this was a bit off. Like, how did we not see this before?
Yeah, no, so it's really good to know. And just on the fun note, in terms of the founder dynamics, I think one thing that's come up in a lot of my meetups recently have been around solo founders and kind of how they're perceived versus a team of founders. What's your opinion on, and again, I appreciate this probably differs a lot between pre-seed to Series A, Series B, but what's your thoughts on kind of solo founding teams? Or solo founders, should I say?
I think there was this whole thing in the industry initially a few years ago, which was, solo founding teams, no. YC also says something like 2 or 3 is that ideal sweet spot, etc. Look, beyond the obvious, which is key man risks, so on and so forth, I still think solo founders make excellent founders, right? If they know how to run their own ship and they know that, what is the North Star? And the North Star is you got to execute. You got to build. If the messaging is clear, do it by all means, right? Again, it's like when you really put it very simply, one thing has to grow, the other thing has to support it with capital, right? You just really remove all that, the abstraction away. Then obviously it's easier said than done. But if as a founder you're delivering on your metrics, and I have some friends who are solo founders who've raised venture capital up until Series B, why not? Just keep going for it.
Yeah, awesome. That's really good to know, because I think lots of founders are worried about needing to find a co-founder because that's the perception. But I think I also hear the other opinion in that if the founder dynamics is bad, that's as much of a concern as if you've got a solo founder.
Exactly. And it's a lot more common than normal, right? It's like founder breakups happen all the time at every fund, right? But if you as a solo founder feel you have the skills necessary to solve for the 3 Ps, which is pain, passion, or problem, that's fine. Do it, right? Definitely do it. And if you feel that you're the one who can, because think about it, right? What does it mean? It's like you're gonna run everything. You're gonna run the business. You're gonna hire people. You're gonna be the first person speaking to your customers. You're gonna be the one solving pain points. You're the one who's not gonna sleep the most. Do it if you want to do it alone, right? Why not?
Awesome. And on the final, just going back to the pitch decks, I know you said about amber flag being too long. What is optimal in terms of like length, content?
I think 10 to 12 slides, pre-seed, seed, just be focused, because you're articulating a vision, right? You can keep a lot of the stuff in the appendix, but to grab people's attention, especially at that early stage where, let's say you validated it, you have an idea, you know the team, and you know your market, that's kind of it. Because you do the 4 Ts and a few more slides, it's done, right? And I also typically tell founders, don't necessarily always put the exact raise amount at the end of the deck. But that's my personal preference. I always say give a range. Don't let anyone know what you want to do.
Awesome, that's really good to know. And in terms of because I think the effort that goes into the pitch as well, there's, from a founder perspective, lots of reach outs, lots of outbound messaging. I know you mentioned you do outbound messaging yourself. What makes an initial pitch or reach out stand out to you in your kind of inbox?
Well, Reese, you and I met with a cold outreach, right?
Yep.
So there we go. Something worked there. I don't know. It's very difficult because we do it too all the time. I did it before when I was doing my MBA. Cold outreach it's almost like a staple characteristic of individuals with hustle across the world, right? But in venture specifically, I think an early sign of testing a founder's hustle is also how a founder essentially uses the network and the ecosystem and the geography to be able to get into the circle of venture capital. Now, I sometimes don't like saying this because this almost means that the industry is exclusionary, whereas a lot of us are trying to make it more inclusionary. But regardless of the background, there are ways, whether it's meetups through what you guys do or other meetups in Shoreditch or whichever city you're in, there are ways to always build into that network. And yes, that requires hustle and time versus a cold outbound, but that is always a much more short way because it's sort of just showing, it's already giving you a data point. It's already giving you a data point that this person is going to go through heaps and bounds to crack that first customer, aka the VC. Right, so it's almost like a way to pre-qualify your ability to win deals.
Yeah. Do you, in terms of how you prioritize inbox, in terms of those 1,000 kind of companies through the funnel, do you prioritize warm intros over cold? Is it more about the actual the kind of pitch itself?
Yeah. And VCs would be lying if they said that they didn't, just because of the sheer volume of the work, right? Where you have to sort of prioritize that. I mean, there are still a lot of LinkedIn messages that I have, and I tell myself, I'm going to clear it on Sundays. But that's because I'm only 4 years into the industry, right? What founders should understand is the deeper you go, right, and the more sort of partners you pitch into, I think they will sort of not respond to that cold outbounds with that much with that much sort of what's the right word for it? With that much sort of adaptability. It just won't happen, right? So I think there you want to be able to understand which person do you want to target. You want to target the junior at the fund, you want to target the senior at the fund, target the first line of defense, just go for it. Let the junior get impressed by what you're doing, right? And then go upstream. That's the best way to do it.
Yeah. Also, is your advice then to have a mixture of both partners and associates involved when they're kind of outbound reaching? Should you be reaching out to everyone in?
No, definitely not the everyone part. Well, sometimes we've seen that. We've also had that, and then we reply because like everyone's got a ping, right? But I would say just try to build a good relationship with one person, right? It's the golden rule of networking events. You go, you make a few good concentrated relationships, and that's about it, right? I do that even if I'm trying to fundraise, right? As a VC, for founders, I think, the juniors are your first line of defense. They will be the ones taking a deal into their weekly deal call, saying, "Hey, I spoke with this company, really, really exciting. This is what I think." Get into that sort of mindset that the juniors can actually be the gatekeepers to the check writers. And the check writers, typically principals and partners, can then already have it pre-qualified from the juniors, right? Because these are people who they have trusted to be able to run that process. That's why they were hired to be juniors in the first place.
Brilliant. And in terms of I guess first line defense, which makes things really interesting, when a company is uploading their deck, for example, to a portal, whatever it may be, who's normally the first person that reviews that deck?
It depends on the size of the fund. So when I was at a pre-seed fund before Speedinvest, it was just 2 partners and me. I was there as an MBA intern, and the way the online forms were linked, they were all zapped together. In today's world, N8N. They were all zapped together with automations, and it would land up in the pipe drive of the partner. So if you're going for a solo GP's website or a super small fund, quickly just see on LinkedIn how many people work there. If it's barely 2-3 people working there, the likelihood of a partner seeing your deck is high, right? If it's a large fund, there are levels that have been created similar to a consulting firm or an investment bank in order to be able to move through volume, right? You want to go low then. You know that your deck is going to go and it's going to go to the associate, right? That's how it goes up.
Okay, brilliant. And on the note of, I guess, building relationships with investors, has there been any standout, messages for you that you generally receive? Or again, coming back to sort of red flags, is there anything in a message you say actually, regardless of the deck, this isn't someone who I'd go back to? See,
a short red flag in a cold email is when you haven't done a basic read on my LinkedIn profile, and it's like, "Hey, listen, I've got this really amazing angel opportunity for you, or something to do 100K. And my profile is clearly saying, look, I'm doing growth," right? So, the good VCs will make sure their profile lays out what they do. But if founders still are not able to catch that, and the cold email is, through a structured software that it just goes out, it's just not worth it, right? It's some of my best cold emails and cold notes to people have taken me hours to write sometimes, because I really want to structure structure my thoughts in the pyramid manner, right? Like, what's my ask? And then, what's the context? I think the best cold emails have that, and the best LinkedIn messages. And the red flags ones are obvious, like, hey, listen, like, I have 100K left, SEIS, do you want to invest tomorrow? Like, no,
Yeah, no, I completely agree. Obviously, we do a lot of kind of cold outbound messaging here, and I'm always of the view of that lots of low quality isn't better.
No.
So, automating at scale, lots of low quality messaging is not going to be any benefit, as opposed to one hyper tailored message a day is much more impactful. We see a very clear return versus a mail merge of 1,000 people. You'll never really get a return on that.
And also, like, honestly, it's a bit of it sounds stalkerish, but like, if you really want to target certain VCs, just look at their social media behavior. You'll immediately get a sense of what they're liking, where they're going, what events are coming up, right? And if you know they're going to an event and you really want to speak to them warm, go to the event. Just be like, hey, look, I want to speak to you. And be like, okay. Because when you put a face to a conversation and then you do an email after, post-event, hey, listen, we met at the Founder Circle event. Here's my deck. Would love to follow up. It's always much better, right? So I think that even if the VC knows they're saying no to you, you will get a response then after that.
Okay, fantastic. And in terms of the, I guess, pre-traction, we discussed earlier around at what point should a founder start talking about a raise? Should they be reaching out as they need to raise, or like, I'm going to be raising in X months, wanted to put myself on your radar?
I think at pre-seed, you should be speaking to VCs when you're in the sparring ideation stage. Like, reach out to a few of the hustlers at other funds who you can recognize. Be like, hey, look, I noticed you're doing this. I'm looking to build something in this. Currently validated with 10 customers. Would love your thoughts. I think that's the best, right? And then you might, we have a guy in our fund. He sort of only does pre-seed founders, and he ideates with founders at the earliest stages in Berlin, right? He's sitting with them. He's speaking with them. He's like, what do you think? I do that with a lot of friends who are building. It's like, hey guys, let's do a product sparring session. I'm doing one at 5 o'clock today. Where we're just going to speak and spar. So I think if you can utilize that, you should, right? And again, it goes a question of how do you get to that network? And then it's what we addressed before. But that's the short way of building hype around what you're going to do.
Yeah, awesome. That's really good to know. And I guess we spoke about the VC landscape, how it's different in 2021, 2022, and I think it's been different every year since. And the market is kind of constantly changing. Have you noticed any changes in founder behavior, investor appetite in the last year?
Well, yeah. So in the growth stage, I would say deals are taking longer, right? There is capital. Companies are doing well, but there are companies that are growing 100% plus year over year at the Series B stages, and they're still not able to raise at the same speed as they did back in 21, 22, right? So naturally, given the macro environment, the geopolitical environment, things have slowed down a bit, right? And I think that's what's happened in the last year. You really need to be, I've seen some profitable companies also, just sort of struggle with further growth, right? It's like, what do you really do? Do you go down the venture route or not? So I think it's definitely changed. Industry themes have changed. Climate has reduced to an extent. Defense has gone up, right? Obviously, this is all outside of AI. We focus our strategy primarily on investing in infrastructure. We're like, look, if you own infrastructure, you own the distribution, right? And the way AI is sort of adopting going into the future, we do believe that with everything getting commoditized, the infrastructure layer stays, and then you have the power to do a lot with that. So, different funds are adapting to it differently. Some funds are chasing the big AI hype deals. Some funds are chasing the defense deals as the need of the hour. So lots going on in that sense. But at the pre-seed seed stages, I think it still stays that the best companies are still getting funded. It's not slowing down at all.
Okay, awesome. And I know you mentioned AI as well. Have you found that's because I think one thing we've certainly noticed in terms of our client base, I would say every other company, SaaS business, is an AI business at the moment that's kind of founding at the moment. Are you finding that there is still this hype around AI? Is it becoming really saturated in that space? What's your view on AI companies at the moment?
Yeah. See so many of those decks, right? And for my colleagues on the seed side, we see a lot of that. I think, what's there in the application layer is it's hyper competitive, right? And at the application layer, I would feel sometimes even just risky as a founder to build something there because, GPT and the big giants could disrupt you really, really quickly, right? So we're seeing a lot of deals. I think you're seeing a lot of deals in cybersecurity around voice AI. You're seeing a lot of deals around voice AI. You're seeing a lot of deals around, how do you build personalization now on the existing LLMs, right? Interoperability between models, right? And interoperability of memory. You're seeing a lot of that. So I think there's some pretty interesting areas per se. On the growth side, I've chosen to not see much in AI right now. I'm primarily focused on fintech. That's where I'm spending a lot of my time, because I still do feel that, again, to Europe's strength, payments and fintech just generally, it's a hot space. There's still a lot of work to be done.
Okay, awesome. Just because you mentioned Europe, and we discussed this before the podcast started, around this perception between raising in Europe, raising in the US, whether it's easier, harder, different.
Yeah.
What's your opinion on, I guess, if a company is struggling to raise in Europe? It is that I think the kind of Dallas flip is discussed almost every meetup I run at the moment.
Yeah.
What's your thoughts? Delaware flip.
Yes. Look, so I spent my formative years in New York, so I'm always really bullish on the US, and I live by this notion that you should always go long on the US. But I think, putting aside the depth of those capital markets, right? Because it's a stat, right? That the American capital markets have that depth, right? When you put that aside, I don't think there is a time difference per se in good companies getting, funded much faster there versus here. Now, the volume of investors who would invest with that same speed, intellect, and sort of excitement in EMEA versus the US, that's a difference. You naturally have more of those in the US, given the maturity of the ecosystem. And more of those type of investors means you increase the surface area of your luck of you hitting around much faster because someone picks on your vision. So short answer, yes, it is much faster to raise there. Long answer is, I would just say, no. Like, if you focus on your business, you can register your entity here. You can register your entity in Germany. You could go through the pains of going through the notary. But if you're building a good product that people want to fund, you will get funded. And yeah, sure, in the grand scheme of things, do a few months really matter? I think the AI evangelists would say yes. The industries I focus on, I would say no. But I would say that the more I see, the more I read, and everything you're seeing on Twitter and so on and so forth, if you're really trying to build something visionary in the application layer and you want to execute at a breakneck speed, kind of have to go to the US.
Yeah, awesome. I think in terms of the feedback I've had from VCs I've spoken with is sometimes they raise larger quicker, but then won't raise again because there's kind of too much equity out of the business. It was too large around the first time, and actually it was the wrong thing to raise that round. What's your thoughts on when you shouldn't be raising? Because I know that's something you have an opinion as well. When is it not right to go to VC?
Yeah, I think that's a great question and something one has to ask themselves, which is, do I want to go on the venture train, right? Because, I could build up a business, get to a Series C of a 400 million post money, own 20% of the business or even lower, and I exit that, I make good money. Or I could just bootstrap a business, build it for the next 10, 15 years. And realistically, from a pure wealth perspective, you may be better off just bootstrapping your business, right? So it's a question to ask yourself, do you want to go down that cycle and that train to take venture capital when you're not your own boss? You will be reporting to someone, you have a board, you have shareholders, so on and so forth. And it's just hard, right? Fundraising is hard, it's not easy. So a lot of times I tell founders that, I've seen companies, the other day I looked at one, it's a 4 million revenue business, profitable, growing 50% year over year, doesn't fit the venture case, but it's a great business. So at that point, you can start exploring other financing options, right? You can look at growth equity, you can look at venture debt, so on and so forth. But for me, the central question around, do you need funding or not, is a question of growth. If you're happy with the way you're growing and with the unit economics you have, don't go for financing, just generally. If you really want to up the notch, go for financing and then decide which form of financing, right? Because the venture form of financing requires you to constantly do this year over year to ultimately exit, because that's how the model works. Other forms of financing are much more flexible, right? So it's a question of, do I? And if yes, what type of financing do I want to go for?
Awesome. I think one feedback I've had as well from founders, particularly more so pre-seed seed, is that they didn't quite realise how the dynamics would change once you have people at the table as well, in terms of what decisions you can make, the direction of the business. I think lots of people don't consider that, as in terms of if you have this vision that you want to execute, it can change when VCs are involved.
Exactly, and more often than not, because you have a board now. And yes, you can maintain supermajority in the board with you and your founding team or your management team, but there are other people at the table now, right? And it changes the direction of your business, right? You may want to pivot somewhere, but the board is not sort of aligning on that. And I think it's very important to understand for founders that, look, VCs do back channel. If any VC tells you that they don't believe them. Every VC back channels, right? Because every VC, not every VC, let's just put it this way, every stakeholder is invested in an asset particularly for their own interest, right? So when you view sort of financing with that lens, it'll give you a very good yet cynical view of how things should be run, right? So yes, it's like you are giving up control to a big extent. Or you make that clear from the start, right? You can give up certain economic control, but governance always remains in your hand. Those are dual class structures. It's a different discussion, but you can create structures like that as long as you're aware of these things. That's why a lot of founders aren't aware up until Series A. I say, oh, now what do I do with my board? But be aware from the start. Be like, look, I'm never going to give up control. You want to join me in this or not? But if you know you're building a rocket ship, people will come on regardless.
Yeah, awesome. That's really good to know. And I guess, but on the flip side of the things changing, I think also VCs add a lot of value to founders, particularly if they're first-time founders and they haven't been through this journey before. I guess outside of capital, what sort of value does Speedinvest offer the founders?
Yeah, I think, we're a large fund. So outside of capital, the main thing is portfolio success, right? Which is the sort of perks and benefits and introductions that we provide to our sort of portfolio companies. And then I would go a level further into that and say, we're pan-EMEA and not just pan-Europe. So what we're trying to do is we're trying to say, look, Europe, Middle East, and Africa together forms a very strong supracontinent, which allows interoperability, which allows movement of human capital and financial capital. And there is strength when you really cross-pollinate these networks. So I think that's what we are coming to the table with versus a typical European fund, right? And then I think it goes down to the individual investment manager that's on your deal. Because what's valuable to you at the earliest stages, it's hiring, it's sparring on go-to-market, it's being available on WhatsApp, it's being available to take a call when needed. It's also sometimes being that therapist that you just need, right? And just to ask someone on the other side of the table, hey, you've seen a lot, what do you think about this? Right? Because if you really want to leverage a VC's expertise, leverage their pattern recognition expertise, right? Anything beyond that, don't, because you're the founder, they're not, right? And I mean, 90% of European VCs have not been a founder before. I myself haven't been one. So I always go into a call with that myopia that, look, I don't know how to run your business, but I'll tell you what I think I know from the outside. And I think that level of self-awareness should be in every investor on your cap table. Because if they're not that self-aware and they're going to teach you how to run a company, leave them. Yeah.
Yeah, no, I think it's really important to have someone who's in that industry, in that space, and can help you future-proof as well in terms of what the long-term goals are. And in terms of the Speedinvest portfolio, because again, investing in some kind of brilliant businesses of really good success stories. Have there been any, I guess, standout success stories from your portfolio that is kind of we should talk about? Yeah,
so Speedinvest as a whole has invested in some standout successes across EMEA, right? One of UK's largest SME banks, Tide, is in our portfolio. We sort of invested fairly early on. One of Europe's largest crypto exchanges is called Bitpanda, is in our portfolio. I've done quite a few deals on the infrastructure side. We just invested in a company called Pliant, which is sort of building the credit card infrastructure for European businesses. Now going into the US, taking on Brex and Ram directly. It's pretty exciting on that front. And there are a host of businesses that we've done in emerging markets, which we've pulled them out from Africa, flipped them into the UAE, and now they're selling sort of in the UK and in India. So it's almost like a Pan-African business that's gone EMEA and Global South. And I think that's important, right? That's taking company building from one region and sort of cross-pollinating it to sort of other markets, leveraging your strength as a firm. That's pretty important, I think, for us. And for us, we view, especially the Europe Middle East corridor, we view it as a very important corridor. We are sort of doubling down on that, saying that, look, we invest in companies that can also sell to the other side. And similarly, in our UAE companies coming into Europe. So I think there is sort of a lot to do on that front, because you can draw parallels and you can help sort of nurture another venture ecosystem and then power Europe's ecosystem a bit more. So that's sort of what we've done a bit.
Awesome. And I know this is going to be really hard to reduce into just a sentence or two, but have there been any key themes that you've seen from them businesses that made them successful? Was it timing? Was it team? What was the kind of driving force behind that success, do you think?
I'll say aside of team. Right, the team's obviously the most important thing, right? It's a people business. Outside of that, I think good governance is something that really stood out in these businesses. And good governance comes from the most experienced investors, right? Ventures and apprentice model also. A lot of funds don't do that. Our fund does that. So a lot of us learn on the boards with other board members, right? And I think, when you're taking on investors in your cap table and they're going to form part of your board, make sure your board has earned the right to advise you before they advise you, right? And having a good, strong, experienced board can really influence some of the good decisions that you make in your growth journey and some of the doors that you can open up as you expand beyond borders. I think it's a very underrated sort of form of company building. And when I was doing IPOs in the US, I think, we would really sort of double down on that point, on good governance and good boards. The first good board that I saw was UiPath. And I worked on that IPO with as an advisor along with Sequoia and everyone. And I sort of can't emphasize that point enough.
Okay, pretty nice. You mentioned IPO as well, and I think this is another thing that comes up in a lot of conversation, particularly because I do a lot of early stage hiring, particularly around the founding engineer piece. So we have lots of conversations around equity, but lots of conversation around how do you actualize that equity? How do you turn it into liquid cash, or is someone going to hold equity forever? I know IPO is really uncommon to actually get to an IPO. In terms of exit events or how you've seen companies, I guess, turn equity into liquid cash for employees, have you seen any kind of success stories there of how that really works and how to incentivize but also give something back to early teams?
Yeah, I think, on the EMEA side, I think it's still not there where it should be, right? As that's what people are always optimizing for, cash versus equity. I do feel that there is a need for more secondary liquidity solutions for employee sort of stock options, right? Revolut did that share sale and so on and so forth. Companies need to do more of that, because when this paper success does not translate into financial success for employees, this doesn't mean anything, right? No one's doing this for a LinkedIn post, right? That's simply put. People are doing this for wealth, and that has to happen. And I think the conversation needs to be happen in that. Like this conversation around wealth creation should happen in sort of the highest rooms in the government as well, right? It should happen in the parliament as well. That look, this whole thing exists for wealth creation. This is not for anything else, right? But the thing is, what I've noticed from my experience in the US and in Asia, Europe needs to, talk a bit about it, talk more about it. It doesn't do it as much as the US does. And the more the US does it, it becomes a self-fulfilling prophecy. That company building, ESOPs, liquidity, so on and so forth. I think we need to do more of it here if we really want this model to work. Because I think we forget that we imported this model of venture capital from the US. So we imported a model from another country of an asset class, and we brought it across the world, and we said it's going to work as is. America's 300 million people. The UK's, what I mean? It's like the UK's a third of that. So if you've imported something, you have to adjust it a bit to localize the model to make it work. And if we know our capital markets don't work, policies should encourage other forms of liquidity to make sure that works. But that's a whole different conversation.
Yeah, no, completely. I think it's a real challenge point at the moment. I think whenever I talk to early stage founders about building founding teams, it's often the same theme. As we'll talk around 0.5% equity, 2-3% equity, and sometimes we're talking a lot of cash value, but it's often so undersold. It's 0.3% rather than that. My advice is always pitch equity like you would to an investor. What's the market opportunity? What's your kind of, do you want a 10x valuation? What does that mean for them? What's the exit strategy? I think So many
100%.
times you're seeing adverts all the time, X thousand plus 0.1%.
Yeah.
There's no context around how valuable that is,
Yeah.
how valuable it could be. And I think that's really important, is almost those early teams to incentivize them, take them on the journey you would an investor, because that's really what's going to get them bought in.
100%. 100%.
I guess just in terms of the kind of myth busting at the final point, is there any, I guess, big myths around like VCs, investment, anything that you find is a common misconception when you speak to founders or?
I think there's just the general misconception that venture capitalists are some, I don't know, godlike people and so on and so forth. Like, no, right? Most of us are pretty dumb, right? I say it. And, we just try to do our job well. But I think our industry definitely needs a bit more self-awareness, right? Just to know who you are as an individual. And for founders to just treat this as, look, you're going to have a mate for 10 years, right? So do you really want to be with this person? And speak to them, right? Understand them casually. Like, sure, they're on your board and so on and so forth, or they're your investor, quote unquote, but we're people at the end of the day, right? We get excited by the same things as you. So the misconception is that it's sort of this, elusive industry and so on and so forth, but it's really not. The more you break it down and the more you see what's under the hood, the more you're like, oh, well, it's pretty fun.
Yeah, no, completely. I think I found that at events as well. Whenever we've kind of done our founder circle events, the mixture between angels, VCs, and founders. I think once you actually get in a room and you have more, I guess, non-formal conversations.
Always
that's
helps.
The challenge. It's often when you're speaking to a VC, you're in pitch mode. You're not in
Exactly.
conversation mode, and it's a very different way of approaching
100%.
conversation.
And that's why face-to-face will only become much more prominent in the next 5 years. It's the single most important thing you can do as a founder today is to meet people in person.
Yeah, but I guess on that note, in terms of the meeting people, for you in particular, are there any, I guess, founder groups, founders of certain companies that you have a real interest in connecting with now and speaking with at the moment?
Always interested in fintech founders, right? For me, that's sort of a common theme and area that I invest in. In terms of communities, I'm very selective on sort of which communities I go for. Naturally, I had some good conversations with you guys at Founder Circle, so I enjoy that. But I think it's a function of just time and sort of what I'm looking for. If I'm a pre-seed seed investor, I'll naturally be more involved, right? At growth, it's a bit different because you already kind of know the companies, right? But from time to time, I go back to LBS, like London Business School, which is my alma mater. I go back to New York and I host events where I went to undergrad. So I'm involved still in communities with places that I was associated with before to just spar with founders, work with founders on what's, because I enjoy this. So I'm like, I'd like to get my hands dirty in that company building discussion because I feel if a conversation of mine can influence how someone's building a company, why not, right? It's definitely worth my time.
Yeah, brilliant. And in terms of connecting with you directly, what's the best way to get in touch with you?
LinkedIn's the best. I typically batch clear messages. So, I'm pretty good at getting to most of my messages. And then it's much faster than email sometimes for me. So, just be direct, just be, focus on what you want. And I'll try and see if I can help, if it's relevant to me.
Cool, awesome. Look, thanks so much for coming in. Really, really, really insightful. I really appreciate you coming in.
Absolutely. Thanks, Reese.
Amazing. Nice to see you, Varun. Take care.
Cheers.